Founders, be honest. When was the last time you felt like you were actually winning? Not surviving, not pretending, actually winning. Over the last few years, you've been told a dozen different versions of what success is supposed to look like. Raise money fast, grow faster, don't worry about profit, and now suddenly, the rules have changed. Again, you did everything right and somehow you're still stuck. So maybe it's time to ask a question we've all been avoiding. Is it time to hit the reset button? Because if the old startup playbook doesn't work anymore, maybe the smartest founders won't double down, they'll start over. And this time, they'll do it on their own terms. I've recently been meeting with a lot of founders that are feeling stuck. Most of them are early stage founders, and they feel kind of stuck in their growth. Most of them are in between some sort of funding round, or they're up against a fundraising market that just flat out sucks. And it all feels kind of unfair because they've been sold a bill of goods by private markets, by VCs, by investors. Until a couple of years ago, those VCs and investors told founders to build a good product that's differentiated, right? Speed to market and scale is crucial to their success. User and customer growth is far more important than revenue. Grow now and figure out profitability later. Headcount could be a measure of growth and viability. They're supposed to go raise a pre-seed, then a seed, then a Series A, all in a short period of time. And that only bad startups bootstrap. Then, founders live through what I'm calling the great VC rug pull of 2023. Everything seemed to change overnight and without warning. Pre-seed investors started wanting profitability. Pre-seed investors, Series A VCs were expecting completely de-risked opportunities. I can't begin to tell you how frustrated I am on behalf of founders and as an early stage investor that so few of these Series A VCs remember that they're supposed to be managing risk capital. I mean, even the largest funds have started acting more like commercial bank lenders than actual VCs. I think their spines have weakened. Their conviction has definitely disappeared. And they all started clawing for allocation in a handful of these wildly overpriced startup rounds. Basically, venture capital as an asset class has been exposed. And I don't mean that in a good way. They've been exposed for being more lucky than talented. They just were in the right place at the right time, and they had money to deploy. They don't necessarily have any particular or specific ability to deal source great opportunities. They were able to syndicate with their buddies. They were able to get into good deals that they never sourced, but were lucky enough to get a phone call to fill that last $1 million or few $1 million into one of these, fast-growing, hot startups. They've shown that they don't really have an ability or interest to develop founders or support them strategically once they invest in them. During the frothy 2018 to 2022 timeframe, private markets overcompensated for those managers' incompetence. To me, it seems like it really wasn't talent. Success was just tied to participation. If you invest some money, you make a profit. The whole damn thing feels coin-operated in retrospect. So startups can't rely on investment capital supporting the previous playbook for growth and success. Where do they go from here? I hope you're enjoying the content, and if you are, please consider subscribing to the channel. Back to the episode. When I was 10 years old, I got a Nintendo for my birthday. The original Nintendo, the NES. Yes, in case you're wondering, I am that old. Most of the games that were on the NES system were arcade-style games. You got a certain number of lives to complete the game, to complete the levels. You couldn't save progress if you turned off the game or ran out of lives. You started over or you quit. On that original NES system, there were only 2 buttons on the entire console. There was a power button, which obviously turned it on and off, and there was also a reset button. If you hit the reset button, you went back to the title screen of that video game and everything started over. If you weren't doing particularly well in a game, if you'd lost too many lives on the first level and you just knew you weren't going to make it much further, you'd probably hit that reset button and try again. And after hitting that reset button, a lot of times you might actually get super irritated and hit the power button. And then you just turn the whole thing off. It was the original version of rage quitting. And much like losing too many lives in the first level of Contra, I think we've hit the point in this venture cycle that founders need to consider hitting their own version of the reset button. And for any of my Gen Xers up there, always remember up, up, down, down, left, right, BA, start. It's likely if you're still watching this video, you're probably struggling as a founder. Maybe you do feel stuck. Maybe you're having trouble raising more money, or you're looking ahead to when you will, and that outlook seems bleak. Maybe revenue from sales isn't covering your expenses. Now is the time to decide. Do you hit the power button, rage quitting your startup because you can't see a path forward, and maybe you're too burnt out to try again? Or do you hit that reset button and figure out how to regroup and make another run at it? Maybe you've learned from your mistakes and ready to move forward differently. It surprises me how often founders don't realize that hitting that reset button is a viable option. Now, it won't be as easy as it was to reset Super Mario Brothers, but it is an option. Before I get any further, let me recognize this isn't possible in every circumstance, and it's not actually as easy as hitting a button on the vintage NES. So for you bootstrappers and early founders that probably haven't raised money, or at least not meaningful money, I went into this in greater detail in a previous episode. Feel free to watch that. But the Cliff Notes version is this: start selling and generating revenue as quickly as possible. Even if that means selling a smaller or earlier version of your product, do not try to make it perfect, make it sellable, make it viable for someone to give you money in exchange for use of that product. Keep your headcount low. You as the founder have to be everything to all people for some real period of time. And the longer you can do that, the better you're going to be positioned in the future. Manage your expenses closely and avoid the phantom expenses. Well, what do I mean by phantom expenses? It's that $9 newsletter. It's that $12 app. It's the recurring expense for something you signed up for 6 months ago and haven't used it in 4 months. If you look at your credit card expenses every month, if you look at the tracking of your expenses through a QuickBooks or whatever, and you go through and you say, okay, here are all these dumb things, eliminate them, because it may seem small, but it will aggregate into a couple $100s a month, which then, of course, means a couple thousand at the end of the year. I want you to wait as long as possible before raising money. Once you raise money, you're pretty destined to start having to continue to raise money in the future. So you create this cycle. And once you raise money, that clock starts ticking. I do want you to try to only raise money for growth, not survival. That's probably the biggest shift now from what it was prior to, let's say, 2023. You could go out to an investor and say, I need to build this product, therefore I need this investment capital. I don't think that's working very well anymore. You could do it through accelerator programs. Maybe you can do it through pitch competitions and non-dilutive funding. But I think you want to treat investment capital as growth capital, as money for growth, not for your survival. And if you do raise money, run your startup like there won't ever be any more money ever again. That sounds extreme, but think about how you would run your business and the strategy you would apply to your startup, assuming there was never going to be any more money. And at some point in time, whatever money you have raised has to get you to the point of at least break even, where your startup can self-sustain. The easiest way to get someone to invest capital in your startup is to first prove you don't need it. I know that sounds counterintuitive, but as all of these VCs have shown themselves to align closer with the underwriting standards of a commercial bank lender underwriting a 16-year-old's purchase of a brand new Mustang, you first have to prove that it's not risky. And the best way to prove that that investment isn't risky is to prove that you don't actually need it, or that you can prove that it's strictly for growth. Now, let me talk to the founders that have already effed up. Those of you that have already taken money, spent it, now you're trying to figure out how to move forward in the hardest fundraising environment of the last 2 decades. Just a quick note, if you're a blitzscaler in 2025, first, may God and your investors have mercy on your soul. Because if you have little recurring revenue and no version of your product is sellable, you can go ahead and jump off this episode and go watch Whistling Diesel tear up a Cybertruck. Now, I think it's easy to get stuck thinking you can't grow because you don't have enough capital to maintain your headcount or your current product development or your current growth curve. Well, because you're right. Unfortunately, many founders equate lack of growth to having no path forward. And I want to double click on that because those two things are not the same. You can grow slower. You can even recede a little bit in your growth and still move forward as an organization. Apple, Lego, Marvel, all got smaller to become massively larger. When Steve Jobs came back to Apple, it was on the brink of collapse. He cut programs, he cut product lines, he refocused on the things that he believed would make money. That's when we all started seeing the products, the iMac. Later on, we saw the iPod and then eventually the iPhone. Lego was selling like t-shirts and clothing and weird stuff. They were in the video game space. And they all pulled back from that and said, no, we're going to go back to being Lego, the company that has little colored bricks and you build stuff with it. And Marvel licensed some of its IP to some movie makers to create the early versions of the X-Men and Spider-Man and then 16 reboots of Spider-Man later. But it got them enough money to shore it up. It allowed them to reestablish themselves as a studio. And then later on, I think they sold for like $4 billion. But again, they all got smaller to eventually become massively larger and more successful versions of their company. I think it's a safe assumption that the strategy you've run to this point is what puts you in this position. You're going to have to make some major changes. Whatever growth rate you were chasing before is irrelevant. Don't index off of that anymore. You're now in survival mode. You need to be obsessed with maintenance and that survival. So ask yourself a couple of basic questions. What products do you have right now that can generate revenue? What's your headcount? And who's critical to keeping the business moving? Remember, growth is no longer an immediate consideration. How much revenue are you generating right now? And what are the minimum expenses required to continue delivering the service or support to maintain that revenue and your customer retention? So once you've answered those questions, how do you run a different playbook? Well, in the most generalized terms, here are some of the things I would recommend. First, cut headcount. Most startups' biggest expense is headcount by far. You're going to be letting some people go, maybe most of them. This is going to suck. Probably the worst thing that you're going to have to do all year, and maybe the worst thing you've ever had to do in your startup. But it's likely non-negotiable. You got to eliminate every expense that's not critical. Try to renegotiate any of your current service contracts or agreements. Be surprised how many tiny expenses you have each month. See above those phantom expenses I talked about. I want you to shift all priorities to revenue and selling whatever version of the product you can reliably maintain and support. Everyone left, everyone that didn't get cut, is now responsible for sales and revenue generation at some level. If you have monthly recurring revenue and you've made the deep cuts necessary, you may actually start generating a modest profit because, again, you've reduced your expenses and your revenue has stayed the same, at least for now. Once you have that sustainable model, once you're kind of status alive, you can start to rebuild. You're going to have to prioritize and do that ruthlessly as you decide what you are going to spend money on and what you are not, so that you don't replicate the same mistakes you made before. Venture capitalists and investors have historically asked startups to grow fast, but now they're refusing to put up the risk capital to support that strategy. It's okay to feel like they've screwed you over and to be, frankly, mad as hell that you've been put in this situation. I agree. This VC rug pull is reckless. You have to decide what you want to do about it. Stop letting them dictate your success and how your startup is going to flourish. So if you've made it this far in the episode, you're probably wrestling with that same question. Do I hit the power button and walk away or the reset button and start again? Here's what I'll tell you. Resetting isn't failure, it's strategy. Founders who will win this next decade aren't the ones who raised the biggest rounds. The winners will have learned, adapted, and bet on themselves. Rebuilding even when everything felt like it was falling apart. Because hitting reset doesn't mean starting over from zero. It means starting over smarter. So take a breath, look at what you've built, and decide, do I quit or do I reset? That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.